Slow down, you crazy child. You're so ambitious for a juvenile. What's going on? What's going on? Brain's not working right now. My brain is not working.
It works for all Americans.
Everyone is expecting a 0.25 cut. I am expecting a 0.25 cut. I'll be totally honest with you. I'm not expecting a 0.5. If we got a 0.5, that shit would be crazy. Could y'all imagine? We see a 0.5er. I can't even fathom. My brain won't even conceptualize it. If we had a 50 basis point cut, might do a fucking cartwheel. I've never even done a cartwheel. Que anda jefe, me no speak de español, señor. One sec, guys. Sorry. What's going on? What's going on? Apple about to give us a 280.5. Is it? I mean, Apple looks fine. It's just chilling. When we got that first move up here at 280, I cut it. I was like, screw this. It's just, you could just tell by the weakness, the lack of follow through, lack of continuation on NQ that you were just gonna chop here. I thought you might pull back even further. We didn't, so that was nice. But yeah. We'll get more information, more trade setups after today. Like, let's get through this, and then we'll move into more stocks. You know what I mean? Like, let Powell come out here and either piss in my Cheerios or, let him come out here and make us happy. We'll see what happens. Buying anything here pre-FOMC earnings? Am I buying anything guys? Y'all let him know. Do I ever trade anything pre-FOMC? I recommend, boys and girls, if your head is stuck up your ass, that you remove it somehow, because again, it's not a good method to have. What's happening with Nvidia? Literally nothing's going on with Nvidia. You're back below 184, but you're just chilling here. Nothing's going on. If you missed out on the news, which I kind of thought you'd get some bad news about this, so let me go in. China, Blackwell. So this is the news that's out today on. This is the news that is out today on Nvidia. Okay, so Nvidia's already addressed it today. So Nvidia responds to a report that China's DeepSeek AI is using its banned Blackwell AI chips. Nvidia came on and said, "We didn't sell any of them to them. We didn't do this. This is a lie. Yada yada yada." So yeah, but apparently DeepSeek smuggled them in. Who knows? It's a dirty game, AI is, but in Jensen we trust, dare I say. Nice hoodie. This is the most, I'm telling you right now, if you guys, I'm going to put you on right now. I'll put you on right now. I don't buy anything else really from there, but let me tell you. Let me find it. Type it in over here and bring it up. Yeah, I think I own every color, to be honest. Big fan. Which one are their hoodies? Where's that? Coats and jackets. Is this considered a jacket? Is a hoodie considered a jacket? I don't even know. Which one are their essentials? I don't care for all this. See, look. You go onto their website and they got all this mumbo jumbo. I don't care about this. I care about comfort, okay? That's what daddy wants. See all this? This is all trash. No one cares about this. We don't want that. Hoodie. Hoodies and sweatshirts, men's. There you go. You go over here, go to the essentials. This is all, I think I own every color. So anyways, it's the most comfortable hoodie of all time. The problem is like once you wash it like 5 times, like it gets a little less soft. Finger guns. What are your thoughts on other countries, Japan raising rates? Well, other countries I don't really care more about. Japan I do care about, just because USD JPY has been a pretty big risk on Signal over the past years, and Japan has been a safe haven. However, do I think it could cause some downside in the market? Potentially, but the U.S. economy is still very strong, and like the race of AI, everything, like it's still the bubble's not popped. The bubble's not on the verge of popping, at least yet. So yeah, I do think carry trade, what's happening with Japan raising rates potentially could be bad. I definitely wouldn't be trading going into a rate decision with Japan, but still fine with it. Those are both and the same. The comment about Papa Powell. I don't even know what I said. I should be saying stuff. You know what I mean? But yeah. So anyways, if you suffer from like this emotional damage disorder of trading stocks, and you're like, what is happening with this stock? And you zoom out and you've done nothing, then like, yeah, I encourage people to zoom out 99.9% of the time. Yeah, Microsoft pretty good dip right now. See, it comes right down to 200 SMA. Came to that 492 two times though. 492 is a brick wall. Y'all can see it back here too. Microsoft's a pretty tough chart. Came right back into that level, little SR flip. You get back above 493, 494 confidently, you look really good. Pretty solid name. Be watching it. Still no news from the Feds. We got like 15 more minutes until we get the Fed statement, rate decision. So yeah. VIX due for a big run. VIX literally just went on a run. What are you talking about? VIX literally was up at $28 literally 2 weeks ago. What are you talking about? I don't know what you mean. And before that, it was literally like another 2 weeks before that. So yeah, typically VIX stays down. Like if you were to run like an average of like where does VIX stay at predominantly, you would see that VIX stays down at lows of around $17 to $15 to 14 maybe for a majority of the time. That's where you spend most of your time. So it would just highlight that. You go back even further, go back into 2024, 2023. You sat down there for a majority of your time as well. So are you expecting good news from Oracle tonight? Oracle's earnings, yeah. I don't trade earnings. Trading earnings usually is pretty stupid for me unless like a stock is really beat up, then maybe. Or if they're like a really cheap name, then I like do my due diligence. Like Path would be a name that was interesting. But yeah, no, I don't really trade earnings. It's increased risk, not really increased reward. So you're going into a trade where these are your odds. Normally, you're going into it where your risk and your reward stay here, but risk goes up and reward stays here. So there's no real like major reward potential off of it, right? It's still pretty normal, right? If anything, it goes down a little bit because you're pricing in a pretty large move as well. So I like to go into scenarios where instead of increasing risk, I can keep reward at the same potential, maybe increase reward, but get risk to the downside. That's my focus, is getting risk lower at all points in time for me. I mean, like the movement of 18, 20, as long as VIX holds. So you're kind of misinterpreting VIX. VIX isn't like going to react to like, in my personal opinion, like I don't chart VIX like I chart SPY or like I chart any equity or stock. VIX is a measurement tool. In itself, VIX is an indicator. That's what VIX really is. So I wouldn't chart it in that sense of like, is it holding $16? Like, is it losing? Like, is VIX ever going to go down to $1? Unlikely that ever happens. So anyways, so I would use it as an indicator. And I would really understand what VIX is before you start like relying on it or using it as like a signal or like trying to trade it or by any means. I would go understand what it does, how it moves, and fundamentally like what it is. Again, you might not want to do that. That might be like the boring path of like actually like educating yourself. But I recommend doing that to anyone and everyone. Thoughts on Lemonade? So Lemonade's getting a lot of like hype again. It's funny when I was like, was it 2021, 2020? When I was like, I think it was 2020, which is crazy. But yeah, 2020 when I was the last job I had, besides working for myself, I guess. But in the apartment industry, my throat's itching. When I was in college, I worked at an apartment complex, leasing apartments. And anyways, I referred everyone to Lemonade because it was like the cheapest like renter's insurance you could get at the time. Anyways, now Lemonade, like it kind of based down here and it's kind of going back up. I think this is a lot of hype, to be honest. I think growth is good as far as earnings are concerned, but like, is it going to be able to sustain? We'll see. I don't know. It's a tough question to ask, but revenue's been upticking. But like this idea that eliminates integrating AI with insurance, like I don't really care about that. Like respectfully speaking, like it's like when people start saying, "Oh, well, you can AI we're integrating AI with Walmart." I'm like, why the hell do I need to integrate AI with my Walmart? Like as a consumer, like maybe as on the back end for the company, cool, but like as a consumer, I don't need AI. Like that's stupid. That's a waste of money. That's hype. So with Lemonade, I don't really maybe I don't understand it. That could also be it. I haven't done enough research on it, but I think like this is one of the areas of the market where AI is like popping off that like I could care less about. Personal opinion, maybe I'm missing out, but like that's just me. I'm focused more on the, the bigger names and where the hype is, I guess, and where there's like a lot of growth potential. So yeah. Yeah, still just waiting here. Yeah, no, nothing out yet. So yeah, Beam and R. Don't get me wrong. Like, look at the stock. I'm not saying not to watch the stock. Would like to see it's about 44, but as long as Bitcoin is doing like making higher lows, bouncing, you look fine. Like, Bitcoin's making higher lows out of that support of 82K, going back to like November 21st. Like, that's awesome to see. Ethereum too. Like, obviously Ethereum matters more, but like Ethereum's bouncing. Yeah, Ethereum's outperforming Bitcoin right now. So get Ethereum back above the 200 SMA. Put my shoes on, baby. Take me dancing. Take me dancing, baby. Take me dancing. So yeah, Meta at 638. What does that even mean? Is Meta at 638? It's at 645. Yeah, I don't know, man. I don't know what you mean by Meta at 638, brother. I had my target too was down here at 642. If you guys follow on Twitter, I posted it on Twitter. So again, do what you gotta do. But it was on Twitter for you guys. Yeah, I actually need to make a video here. I should have made a video just now. Damn it. Let's cook one up real quick. Let's cook up a quick video for Twitter. I haven't made one today. They kind of dead on the day. I really have not done anything. Discord's probably pissed at me. Like, Tyler, you're not trading. I'm like, it is FOMC. And again, why did I not trade? This is a great example. You're trading in a clear as day range, making lower highs. So again, lower highs here, as you can see, and all past few days, really, this whole week, really, just back and forth, back and forth, back and forth, back and forth. I literally had God for my birthday. He said, "You know what I'm going to do, boys?" You're welcome, Tyler. I'm going to get the NASDAQ, put it in a nice little range, put a bow on top. You're welcome. Hope you have fun. I am not having fun. Confirmed. Still love BM&R. BM&R is like the only high risk, high reward play that I like or am considering out there. But like, as far as love it, I want to make sure we understand the word and terminology of love. Like, I love Nebius. Like, Nebius, I love it. Like, I'd put Nebius in bed next to me at night. I would rub some lotion down her. I would say, "Scoot over, Allie. Nebius is in bed with us." She would say, "Okay." That's how that would go. BM&R, do I love it? Like, do I love my dog? Yeah, I'll build a dog house outside, but am I going to let the dog get into bed with me? No, that's crazy. So again, perspective. PayPal, yeah, PayPal's down in the trenches, Trench City, like legitimately. If you just like want to buy stock, buy and forget. I mean, buy down here. This is the area, in my personal opinion, on PayPal. But it's just a stock down here. You stock by the end. You get above like $68 up here. Like, I think or the 200 SMA. I like it back. I think you can get dangerous. You know what I mean? You can get a little dangerous if you start getting above $68. But until then, you're just trading a range. Again, you've been in the range going back to 2023. So, do what you got to do. Salute. If JP doesn't hose us, I'd buy me some BM&R. I don't know what that means. I don't know what that means. You don't have to explain. I don't want to just keep it PG. I don't know what that means. I got 7 minutes on the clock till Jerome Powell releases his little statement. Also 2 minutes. I got to pee really bad. Not gonna lie. Should have went pee before the stream started. Key levels of watch and NQ, please. They're in every single YouTube video, believe it or not. So yeah. They're in every YouTube video. PayPal stock has their investors turning tricks at the truck stop at this point. That stock is trash. I don't think PayPal is a trash stock, you have to understand like why stocks are going crazy right now. You know what I mean? Oh, they meant Jerome. They meant JP Morgan. But no, true story. So yeah, like, and I made a video, and some people hated on, some people got the video, what I was saying, and some people like were pretty like mad about the video. But like, in my personal opinion, if you look at PayPal, like if you look at the market of what's growing right now, in my personal opinion, like this is just me taking a step back, looking at the top performing stocks in the market over the past year, 2 years. Okay. All the names that are like performing great, going up consistently, are having really good growth on revenue. And I mean, honestly, that's logic, that makes sense. Okay. Now, like a stock like Coke, let's use Coke as an example. Okay. Now, Coke is a better performing stock, obviously, than PayPal. I was gonna say Pepsi, but I use Pepsi too. But Coke is like a steady name. Like it does well, it's good, it's a long-term name, you just buy and forget it, right? Now, Coke just chills here. It doesn't really do nothing crazy. It goes up. It goes, it's okay. Pepsi, same thing, right? Pepsi got a little volatile for a little bit, but kind of just chills. When it was down here at 130, undervalued, saw a little rise, but it's not going to go like, okay, it's undervalued. It's going to go to $200. Okay. I think that's the same way I look at PayPal, except PayPal isn't as safe as a name as Coke or Pepsi. Those are just like strong, long-term moat stocks that are protected, insulated. Like they're not going to go anywhere. Okay. And I think that's the thing. So if I go over to PayPal, and again, this is just out and do what you want with this information. This is just my personal opinion. Okay. You look at total revenue. Yes, it's upticking. Yes, total revenue has been awesome. Okay. We can all agree total revenue has been cool. I can bring this over so you can see the whole thing actually. Bring it right there. Okay. That's been great. But when you look at total rev change, you can see the growth on revenue has slowed dramatically. Now, again, overall, like I can bring up Apple, like their growth is going to slow down as well, and it'll peak, it'll perk up sometimes, but there's been no perk for like the last 10 years on, well, you had a perk there from 2020, and then it went right back down. And so they're just not growing. That's the issue, or they're growing really slow. And then you also go into their earnings statement and they talk a lot about how the consumer's weakening. And when you're the only company that's coming out and saying, hey, the consumer's looking weak, but everyone else is beating earnings, growing, it's like, well, what's happening here? I think that's the problem with PayPal. Do I think it's going to go bankrupt? No. Do I think it's going to collapse? No. Like, I think it's a name you buy. You can make a few percent on it. I think it's fine. But like, I just don't. Maybe they change. Maybe they change some stuff. I don't know. But as of right now, that's how I view them. When you just look at the numbers, look at growth. I mean, like I said, just go look at the names that I performed over the past year and 2 years, right? Any name that's either in a really speculative market, like Oklo, it's a really speculative market, or they're having substantial growth. That's the story, okay? But yeah, so anyways. Analyze Webull stock. There's really nothing to analyze. It's just, yeah. I mean, people like to compare Webull to something like, Robinhood, and it's just not. Like, if you go look at Webull, like, I mean, the revenue, actually, earnings weren't bad. Like, but like, you're not going to get that much data here just because they recently went public. But like, I want to paint you a picture so you can see. So their total revenue here on a year. So this year they're speculating to make around $500 million. Okay, on a year. Now Robinhood's making over $1 billion a quarter. Okay, so Robinhood's way out of their league, right? So comparing Robinhood, SoFi, Interactive Brokers to this name, in my opinion, is a joke. I also think Webull is a shitty. I think it's one of the worst platforms you could trade on. The data is delayed. It's just, I don't know why people like it. Moomoo's a better platform. It just has a really shitty name. Like, I'm telling you, I'm not even sponsored by Moomoo anymore. So I want to clear, I'm sponsored by Public. So worth mentioning. Okay, I want to make that abundantly clear. Telling you right now. But there's nothing really to evaluate. I mean, yeah, if you hold above 950, you look fine. Your IPO low, awesome. But I mean, yeah, like, I would rather go buy Robinhood, personally. Do what you want, though. Do you like ARM long-term? I think ARM is a big winner here. I think also, too, ARM is partnered with Amazon for their chips that they're making. So if you guys missed that news as well, Amazon, it's not a TPU, it's whatever the hell they're calling it. But ARM, I think, is the one that's manufacturing those. I would go double-check, but I could be lying, but I'm pretty positive I was reading that. Anyways, we should be getting the press release here in a second. Let's see what the Fed says. Big, I'm not gonna lie. Is that homie? I think that's old Razzler Dazzler. I'm not gonna lie, Razzle Dazzle. I read that one. I read that one a little wild. I did not read an M. I was about to say, okay, pause. Major pause alert. Let me bring up Discord, the news bot over here. I might get it first over here. What do you say about your analysis on Uber? I think Uber's a good company. I think Uber's a good company. You stalled out, couldn't hold 97, 98. Pulling back. I think it's a big level down here, though. You're at a big support on the daily. Right there. 81, 82 bucks. Huge level. Monster level. Special level, right? Stay above 82, you look good. I don't like to hear below 200 SMA, but we'll see what happens here. Lift also, too, getting back into the range. So it might be a get away. Yeah, 25 BPS cut. Nothing out of the ordinary. That's what we expected there. The market said, I like it. I like it, boys. Maybe the market wasn't pricing in a cut. That's actually crazy if it wasn't, but wild. We'll see. We'll see. Don't fall for the day. Don't fall for the Carmelo pump fake. Don't fall for it. I really want to see the statement. Press release. Where's the press release? I might harm myself if I don't see the press release very soon. I'm waiting for this to be released. 1 minute until 2 p.m. Thank you, brother. I needed a clock. My wife didn't get me one. I asked for one for my birthday. She said, can't get you a clock for your birthday, Tyler. I said, thank you so much, wife. Thank you so much. I think I answered all the questions. Netflix for the long term looks good. I'll check Netflix in 1 second. Dude, at the piss so bad. I just want to read this. All right, give me 1 second. That's funny. Look at that level. Who makes up the levels? Who does it, boys? Who does it? Look at these levels. That's not even, and the best part is this level is not even, it's not even a key level. That's the funniest part. It's just like a intraday level that we made, and now we're just bricked up there at 25.73. Look at that. Who makes it up? Woo! Your mom might change. Your dad sure as hell is going to change. He's going to get grumpy when he gets older. Your kids might change. Your girlfriend's going to change. Your wife, let me tell you right now, things change. Things change. Sometimes for the better. Sometimes not so much. Okay? But let me tell you what doesn't change. Papa's levels. Look at that one. Woo! That's beautiful. That's a good one. That's a good one. Love that. That's a good one. That's a juicer. That's a juicer. But still, you're in the middle of your range. Literally nothing's changed. So we'll see. Love this PA. I'm not a huge fan, not gonna lie. Pretty tragic PA. Bro, give me I'm just trying to read this. Like, the fuck? Am I missing it? Like, did they release it somewhere and I'm like just bricking it? Like, it's usually right here in press releases. I gotta be wrong, right? I see the Federal Reserve projections. I don't care about, oh, there's a statement. I found it. Found it, boys. Found it. We'll just use this for now. Well, actually, no. Copy. I changed my mouse last night, too. Okay. I wish I could bring up the last one also. That's really, honestly, if you're trying to understand like how to like interpret anything from the Fed, what I recommend doing too is getting the previous report. And I mean, I read these so much, like it's just like I can kind of tell when other words get added in or taken out. Anyways, but you want to compare and contrast because usually it's the same exact statement with like 3 sentences changed. When they start to change a lot, that's when you're like, okay, this is probably not good. Available this is new. Available indicators is suggesting that they don't have any PPI, CPI, or PCE data, or a lot of unemployment data, right? So keyword there. Suggests that the economic activity has been expanding at a moderate pace. Job gains have slowed this year, and the unemployment rate has edged up through September. More recent indicators are consistent with these developments. Inflation has moved up since earlier in the year and remains somewhat elevated. Again, this part is the stupidest thing that I've read all year because, again, we've gone over this, and I want to make sure people understand this as clearly as possible. CPI, investing, you can look at any of them. I'm looking at CPI because I think CPI is the least, in my opinion, I think CPI is the least, like, it's doing the worst, if I had to say. PC doesn't look that bad. So let's go look at this for an example. So people want to keep saying that inflation's rising and spiking and this and that. Like, I want to be really clear about this. Let's be let's be abundantly very, very clear about this. This is back in 2022 at your high of CPI at 6.6, right? Okay. All the way down. Now, again, if we were in 2024 saying, oh, we're spiking, boys, inflation's spiking, right? Oh no, you kind of dip down and we're just still sitting here. Again, that's where we're at right now. Now, granted, we're missing some data, so we'll see. But as you can see, is it really spiking? Even and people want to complain about tariffs and all this other shit. Like, and again, be like, "Oh, you're pro-Trump. You're a righty." I could care less. I care about making money in the market. That's all I care about. Okay, as long as they're not saying crazy stuff like committing a genocide. Right? We're not going to go on that. We're not going to go on that subject though. We're not going to talk about that one. Right? We don't talk about that country here. Everyone gets mad about it. But as you can see, inflation's pretty stagnant here. Worth mentioning, right? So everyone wants to, attack this idea that tariffs or this and that. I'm paying so much more on my bill. I'm like, you were paying that much for groceries a year ago. What are you talking about? Go outside, stare at the sun, pray to Medicaid. I don't know. Anyways, next subject. Okay, so somewhat elevated. Sure. Okay. The committee seeks to achieve maximum employment, which is very important to understand that, and the inflation rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to risk on both sides of its dual mandate and judges that the downside risk to employment rose in recent months. Also important. I think all of this is going to be the same. Lower target range. Considering current income day evolving outlook. Yeah, it's still looking for the 2% objective. I wonder what they're going to talk about. They've been buying back mortgage-backed securities, so that's pretty bullish. The committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term treasury securities as needed to maintain ample supply. Yeah, so that's pretty good. So we'll see what they say about this. It's funny that that's the smallest area here. This doesn't really matter. Okay, so basically, again, one sec. Sorry. Yeah. So again, it's very important. People want to also focus on. I've been saying this for a while. The dual mandate is we ignore this a lot, which is very interesting that people choose to ignore. Now, whenever I'm making a video too, and I always encourage you guys to ask me questions. I really do. Like, especially like if you think I'm being biased. Okay, has Powell spoke yet? No. It literally, if you go to investing.com, look at the economic calendar, there's literally a timestamp on all of it for you, brother. Literally a timestamp right there. Go to economic projections, Fed statement. Got this, Fed statement, and then press conference. That's when we talk. The press conference, 22 minutes on the clock. Okay. Anyways, yeah, I do agree. Powell's the most important thing that's going to happen. I totally agree. But, it's very important that you're like unbiased with what you're looking at. And I know it's hard, like especially like if you're always in a trade to be like, okay, well, I want to be trying to be biased. The opposite side of your trade is very difficult, right? Or being unbiased, right? You want to agree with what your thesis is as far as you're investing. I get it. But the hard part about this is despite them talking about what's happening with, inflation being elevated, like the dual mandate, it's very important to realize the first part of that mandate, of the dual mandate, which is arguably more important, is employment. Because realistically, if employment, let's say it surged to 10%, which would be a dramatic number to say, but let's say it did that, the economy would be in shambles, like absolute shambles, turmoil. The president's ratings would be in the negatives. Like it'd be terrible. Like there'd be chaos. Okay. That's the main focus. And then they go into trying to handle inflation, et cetera. So very important to understand, like that's the main part here. And this continues to be a major, major issue. It's such an issue that again, like I went back and said back here, I might've deleted that, but you literally had, and people hate when I bring this, this lady up, Lisa Cook. You literally had Lisa Cook say right here, AI, this is hilarious that she said this. AI could both improve and destabilize markets. And she's talking about in the employment market, right? Which is comedy. Like that she's like, no idea what she's talking about, like to be honest, but whatever. So anyway, so you're even seeing the Fed comment all about that, which I do think in the short term, you're going to see jobs get hurt off of AI. But anyways, whatever. All I know is that's not a good job market if you need one. Dots on a plot won't change that. I agree. IWM juicing up. IWM. Yeah. IWM's. Got a little bark going. Sometimes you got a little bark out. Allie hates when I bark. I tell her this dog isn't all, it's not all bark and all no bite. We got a little bite with this bark. So she knows when I start barking, things get a little dangerous around these parts. But yeah, getting above 253 breakout, massive risk on signal, but pretty impressive as well. So, Powell make or break. I already answered that. So anyways, where we're at right now, got your 0.25 cut. Still look fine. We're just chilling here. Got about 20 minutes till Powell gets on the stage. But yeah, if you have any questions, anything you want me to cover right now is the time to do it. I'll answer your questions now, but once Powell starts talking, I'm getting off. I'm just going to be listening. So if you have questions, ask away. Ask away. NVIDIA is still sitting there. It's at 184. It's the same level. Again, if you're confused by the levels, they're literally lines on a chart. They couldn't be more clear. You're sitting at resistance. You've been pinned to this level for a while now. So you're literally doing nothing. Hey, I know. I genuinely believe the way that I chart and format my content is the simplest I could make anything and everything. There's literally not secrets or special models or anything like that. Right now, it's the trend with trading education and trading content is I made my own model, which I'm that's the craziest shit I've ever heard about. If you actually believe that some 20-year-old kid made their own trading model, you might actually be brain dead. I'm dead serious. If you actually believe that, it's crazy. That's yeah, it's crazy. My question is, how's your day, good sir? Oh, hey, everyone asks what can the dog do for them, but not how is the dog doing? Appreciate you. Doing well. Cisco Ascending Triangle, Lemonade as well, looking for a BRB. Nice. Do you use any gamma exposure options flow? Your setups are just TA? Primarily TA and understanding how the market's moving, but sometimes I do use flow, Meta last night. Yeah, Meta was a juicer. I mentioned it on Twitter. So again, some people literally bail out of Discord you kind of give all the information on your socials. I'm I give a lot of information, but anyway, so Meta last night I talked about it, but I went over the massive puts coming in on Meta as well here, which is crazy because they had big orders on Meta as well so there was 2 big orders that came in. Trying to find them. So it's funny. So those stuck. So you had your 620s right here on Meta. We might not be able to see it, but anyways, they're right here. You had about 10,000 contracts and open interest get added in overnight, which was crazy. And then I believe on the weeklies, you had a shit ton as well. So on the weeklies, I think it was the weeklies. I don't think these stayed on there. They just day traded them aggressively, which is crazy, but they did. Yeah, not as much on here, but you're seeing still a lot of 630s on volume. Look at the volume on this. That's insane. The volume on the opposite side, you have some decent volume coming in, probably just strangling it, but anyways, so I use it sometimes. I don't focus on flow. Flow can be deceptive in my opinion. Tesla coming up with investment app, which can give 240% year return. Can this be a game changer? So this is actually really interesting. So I don't think people understand the regulation and scrutiny that could happen if so this is very interesting actually. So my dad me and my dad have some random conversations, but one of the conversations that we keep talking about and he keeps sending me is he's Tyler, what are you going to do if AI starts investing for people or making content and stuff? I'm well, I'll be fine. It'll probably help me make money if that's the case. But on the other side, you have to understand like how much risk a company brings on by giving financial advice and giving because at that point, if it was investing and like showing you on an investment app, it would literally be giving you straight up investment advice. So they could be liable for some losses in some way. I mean, I don't know all the rules and regulations on it. I try to be careful with what and how I say things. But yeah, so I don't know that I don't think Tesla is going to have an app that's going to make you 200% on the year. That if Tesla had that app, they would just use it for their own funds, and then they would just trade their own funds and then just grow their cash on hand and become an even more valuable company, or they would sell that to someone else. So I don't think that's ever going to happen. But yeah, Poet. I don't really know what the stock is. You guys love it. You guys have talked about it for a while. It looks fine. Held a 200 SMA. Looks fine. Resistance at like 750, 770. For TPT news rule, do you have to be flat until a minute after Powell speaks? Just pass the eval. Appreciate the promo. No worries, man. Thank you. I appreciate you, man. You support the channel. I would read the rules specifically. I don't want to like mislead you. I'm pretty sure it's pretty exact though. TPT news rule. I don't ever trade news in general, so yeah, be totally honest. Yeah, no open positions 1 minute before or during or 1 minute after the event. So probably while Powell's speaking, I just wouldn't trade. I mean, that's what I would do. I mean, you can do whatever you want, but yeah, just with the chance that something negative happens. Can you tell me what your chart analysis and daily time from Lunar? I don't ever trade Lunar, so probably not gonna like the stock. So yeah, I don't know. So I wouldn't trade this for myself. I mean, you're getting back with the 200 SMA, which looks fine. It's just not a name that I'm would be interested in. Clear resistance going all the way back there. So above 1320, you look good. Until then, I'd be careful. Upstart remounts in the 50. If Upstart remounts 55, 54, I'd be interested. Until then, I just don't care for myself, man. I'm not being rude. You're weak. It's a weak name right now. I think Affirm is pretty interesting down here. Holding 65. Let's see it. This is more interesting. Room towards like 78, 77. Interesting there. Especially where Affirm and Upstart and these financial companies get interesting is as we move into the new year. That's where they become bigger opportunities. Because again, this is how I think this meeting is going to go. Personally, it's my personal opinion. I think you get your cut right now, but I think it's unlikely that Powell. I think it's unlikely that we cut rates January and February. If we even have, I don't even know our next Fed meeting. I think our next one's in January, I think, but I can double check for you. Let's go to interest rate. Where's it at? Decision. I will say Jordan trolls me for using Safari, and I actually totally agree. Safari is trash. I need to get off this. The problem is all my stuff is logged in on Safari. I need to just go to Chrome, completely. I'm just being lazy though. So show more. It should show the next one. What the frick? Oh, it's not showing the next meeting. Well, we'll see we'll have one in January, then we'll have one in March. So February you don't have one, March and January you have one. So anyways, yeah. So I don't think you're gonna get cuts until maybe March, personally. I could be wrong though. I could totally be wrong. I don't know. See, maybe jobs data comes out horrible and they want to keep cutting. We'll see. But yeah, that's kind of how I think we play that personally. Who are you so biased on NVIDIA? Are you holding the bag or something? What does that mean? So, Rubbing Lynn, is that your name? I don't know what your name is. You comment on Twitter. Guys, I really try not to be biased. I again, like I say, I always try to go into a lot. If you ask me a question, I try to give you a reason. I try to break down That's how conversations work. If like you say, hey Tyler, like what's your favorite football team? Like what's your favorite college team? I'm like, oh, I like Texas and I like the University of Houston. Those are my two teams probably, right? You'd be like, well, why? I'm like, oh, well, I went to the University of Houston and I grew up like with my family as just Texas fans with my dad. Like we used to watch the Rose Bowl. I remember watching Reggie Bush and Vince Young when I was a kid, even though I liked Reggie Bush when I was younger. But like that's just memories. So I give you reason and logic. So if you say, well, Tyler, why do you like this stock? Well, then I give you a reason and I give you logic to why I like it. Like NVIDIA having $500 billion in, revenue sales and contracts already signed for 2026, new sales going to China. You see, that's logic, that's reason. But when I'm trying to find this guy's comments. This guy's literally a crazy person. And I try not to be rude. I've really tried to cool it off with like reacting to people. But like when you're just a weirdo, you're just a weirdo. Like, you know what I mean? Like that's the way it is. So this guy keeps responding on all my shit. And I can tell it's him because he's the same profile picture, right? So I'm going to mute him here in a second and block him. But so his name's, I guess your name's Ruben. I don't know. So if you go to his replies, he literally just comments on all my shit, some random ass. I guess all he does is comment to people all day and they just never respond to him. So that is tough. Oh, I guess I don't feel as creeped out right now. Anyways, but this guy literally just comments on all my shit, right? Like literally every NVIDIA video he comments on. I can't even find it. Yeah. 25 is kind of baked in. I think the long yield, the long end of the yield curve will increase despite the cut, which again, like, the bond market right now, the bond market's very forward looking. In my personal opinion, yeah, you might get a spike on the bond market, but the bond market's looking at what's going to happen when Powell's replaced, because that's when everything's going to change, which I've been saying too. So very important to understand that. I'm trying to find this guy's shit. Dude, he comments on everything. I haven't made an NVIDIA video in a few days though, so that's probably why. I can't even find it. There it is. This is actually like right here. The US to allow NVIDIA H200 chips exports to China. This is actually negative news. H200 is weak to NVIDIA. I doubt China will even buy it. How is it negative news? It's only increased sales. So like people can't actually say facts. They can't say things. They just like, there's crazy people. And again, like I try not to respond and stuff. But the thing is, I try to respond to all your questions on Twitter. I really do. Unless it's just like something like not a response, like appreciate the video. Like I'm not going to just like it. I don't need to respond to that. But like, I really try to respond to you guys. I try not to like I always say, like guys, you guys support me. I'm going to try to help you guys out as much as possible. But yeah, like I just encourage you guys, if you ever you're like, well, why didn't Tyler respond to me or this or that? Like provide some logic and then like, I'll go into it. But like, if you're just going to say crazy stuff, like I'm not going to respond. Like I just, believe it or not, like I have some time. I don't have that much time on my hands. Jensen from NVIDIA was on Rogan. I saw it. Some of these guys are paid to troll. They get paid to buy the comment. I have no idea. I don't care. It's just like people just wonder why I mute them. Like you're a weirdo. NVIDIA is so interesting because it's been sitting on 184 since August, despite so many solid numbers. Yeah, no, I mean, NVIDIA is nice. I mean, you're just chilling here. But like, again, like I always encourage people too, when you're looking at a stock, just take a step back. Okay. Like that's the number one thing I recommend. So let's take a really big step back to the weekly. Okay. Let's get rid of all the drawings. And again, looking at this chart, is this bearish to you on NVIDIA? That's just a logical, real question. Is this a bearish chart? I'm not like trying to get people to side with me, and I'm not trying to do that. I'm just asking. Higher highs and higher lows. Now, if NVIDIA were to break below like 164, I could see us coming down to 150, the 200 SMA. That'd be awesome. I will say, if NVIDIA touches the 200 SMA, it'll be interesting to see how many people start buying that thing. But yeah, so like as long as you're making higher highs and higher lows, I mean, you haven't even broken below September lows. I'm just saying, you made a higher high, you're still making a higher low. I'm just talking about the facts. So you're kind of pinned there. You know, the same thing happened at like 150 to 140 here. We kind of sat there for a while, rejected, coming back into it, and then we eventually popped and broke and went crazy. So yeah, it is what it is. It's also worth mentioning it's multi-trillion-dollar company, so it's not very easy to move like $5-6 in the stock. Thoughts on the option exit next week? I don't know. I'm not trading any options into FOMC. So yeah, I'm not. But yeah. Wish you the best of luck. Gonna mute my mic and everything too once Powell goes live. Want to address that too. All right. This is the only problem with having a goddamn Jumbotron. I'll have to like edit this shit, unfortunately. One second, let me grab a new display. It's fine. I'll just grab the screen in a second and just blow it up. Doesn't matter. If interest rates come down, how would that affect realtor stocks? What do you mean realtor stocks? Housing stocks? Like what do you gotta elaborate. I mean, all you really need to watch is the 10-year yield for mortgage rates, in my personal opinion. I think most agents would tell you the same thing. So yeah, the 10-year yield goes down, 30-year mortgage usually goes down. Also go to Mortgage News Daily. This is a really good website for tracking any and all mortgage information. Just letting you know. Yeah, the mortgage rates are just sitting low, like 6.3, 6.2, just chilling right now. I don't think you're gonna see an aggressive drop though on below 6% until like March or May of this coming year. But yeah, GEV went wild today. GEV, like, I think this is a name you gotta hold, to be honest. But yeah, this is when I made the video down here. So yeah, like you're killing it from 540 into 720. Yeah, pretty incredible. I'm glad you guys caught it. Posted it in Discord too. I don't know if anyone took it, but yeah. GEV, I was telling you guys, we went down a whole list on the channel. These were our top 3 low risk, easy buys. We had Meta at 600. That went to 670. Congratulations. VRT versus NVT. I said VRT was my favorite. NVT has a lot of potential. And then the 3 energy names, GEV, Bloom Energy, NRG, they're all doing pretty well. NRG was a riskier name, or like maybe an up-and-comer name, less risky. Bloom was the real risky one, but again, big bounce from Bloom, 88 into 120. So, yeah. Those were pretty good movers. Energy's nice. I don't think energy's not a fad either. Like energy is going to, like, this is my viewpoint too of if you're playing these, if you're looking to play, one sec, I'm trying to find, yeah, come back to this. If you're looking to play, you know, the data center plays and you want to take less risk, well, play the names that are going to benefit no matter what. You know what I mean? And what does that mean? So if they're doing these manufacturing of all these data centers and you don't want to trade and own the names like Nebius or CoreWeave or whatever else, then take a step back. I'm like, well, who can I buy that's constructing these? Who are they contracting out? What are what companies do they have to buy for the cooling of these data centers? That's one of the most expensive parts of the business. What about the energy? Who's supplying the energy? Like those are more risk free. You know, they're not doing crazy build outs. They just, you know, these are just expenses that data centers have to use. And that's why I was going through that sector and why I was going through cooling and specifically energy. So, and people, I told you guys in the video, like everyone thinks GEV, it's too expensive. Like, dude, it's up $200 basically since we talked about it at 5.4. That's crazy. That's absurd that GEV is up $200 since we mentioned it on YouTube. That is honestly, it's insanity. Like, I thought it was a great name, great play, but I didn't think you'd be back at 720 and what is that, 3 weeks? That's insane. Absolutely insane. Do you think UiPath will revisit? Dude, I don't know, man. I really don't know. I hope so. I'm actually like, I'm kind of being careful making too many videos about it because I like UiPath a lot, but I also like recognize that, like, again, like it's not my fault if someone YOLOs money and they lose money on the channel. That's not, I don't think it's my fault at all. Like I just talk about what I'm doing, what I'm trading, you know, that's the point of the channel. But I'm not, I try to go about it as responsibly as possible and understand that, like, hey, look, you know, people do blindly follow the channel and maybe make, you know, investment decisions not smart. And I try to, you know, understand that and try to be as, you know, as transparent, honest, straightforward as possible about everything. So I'm careful about mentioning too much UiPath because it is a risk. I think, you know, it's a smaller cap, so there is some risk there. But on the other side, like, I do think it's one of those small caps that it's profitable. It's a big part. It's a big factor there, right? It's a big factor. They just turned that profit too. And I think that with the next phase of what's going to be happening with AI, I think that's going to be all revolving around robotics. So yeah, I think that's really going to be it. I think that's why it's so big right now, but I like UiPath a lot. Look who is selling the pickaxes during the gold rush. That's how I like to invest in the AI race. Amen, brother. Yeah, I'm liking its potential. I mean, I would go look at the finances. It looks good. Looks good. Doesn't look bad. Oh, Papa Powell. All right, boys. Blow this thing on the Jumbotron. What's happening? What's happening? Wait a second. I'll blow it up, I swear. Why does it not do this? It's pissing me off. Okay. They said, Tyler, do you hate your life? I said, just a little bit. One sec.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well-positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now, too. So it's partly that consumer spending has held up. It's been resilient. And to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So, interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions. And we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. It can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter. It's
not something I want to address here, Andrew. We're not we're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
No, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, then we try to, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, it takes, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Mike.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent. Once you get out past the very short term now, break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market. Because the labor market, unemployment was very low, if you remember, when inflation was very high. There was a labor shortage, so we could focus entirely on inflation. Now, it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what? On
the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? So that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think, again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having, social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So thank you very much.
I mean, overall, pretty amazing, pretty great. Couldn't have gone better, to be totally honest. I mean, Jerome Powell's really out here trying to pump. Is he trying to pump AI? I couldn't tell, to be honest. It's like a dream come true, to be totally honest. Absolutely incredible. Love to see it. Other than that, though, yeah, market looks great. You're into your key levels now, looking for continued upside as well. Give me a sec. I'll pull it up so you can see the chart. Let me see. Get rid of this. Go to this. Let's see. So again, when you look at where we're at and how we're moving back here, let me set this up. Right there-ish. Seems right. Is that right? Let's see, right there, I guess, maybe. That's as good as it's gonna get. Anyways, yeah, no, it's literally shit went pretty well. So I mean, if you look at NQ right now, NQ's literally cruising. You want to see us above 25.87 ideally. As you can see right here, you're kind of coming into that spot literally right now. So can't make up the levels. You start mounting that, you look really good. He even commented on tariffs, again, saying that tariffs aren't killing us on inflation, which I literally talked about before any of this even happened. I literally brought up what was happening on investing.com with, CPI. You go look at core CPI here. I mean, again, people saying that inflation's surging due to tariffs are idiots. So as you can see here, inflation's clearly leveled off and ticking back down. We'll see what happens with more information. But yeah, so overall, really good. This is what we were looking for. This is what we wanted to see. I think now you can kind of lean maybe into getting more aggressive on the market. I'm not going full sin crazy just yet. However, I do like the action of where you're at and how you're moving. Names like Apple probably going to be leaning towards a long here, getting back above 280 as well. NVIDIA, I want to see a 184 hold. You still have a lot of news coming out from there, so definitely be watching that. But again, CrowdStrike, very strong aim above 517, probably worth a long there. Microsoft finding buyers on here like that as well. Oracle has earnings tonight. Be careful there, but could be really interesting. But it's crazy. Powell was like almost like long. He was, you would think he's long on AI. Dude was hyping AI up so much. I was like, this guy, one of the boys. So again, what you like to see, Bitcoin bouncing a little bit too. So we'll see what happens. But overall, big fan. Update on Meta. Came down to our target, so looks decent. That's what we want to see. Hold 649, 650. Look good back to the upside. But 200 SMAs right there, so can't get too aggressive. Big level. Tesla bouncing back up as well towards 457. Above that, looking towards 460, 465, 467. So overall, pretty nice. Appreciate the follows, guys. Video coming out probably around 6 o'clock, 6, maybe 7. I'll have that all out. Probably post a video pretty quick here on Twitter as well. A little quick breakdown. But like I said, guys, I mean, really, really good day. I mean, phenomenal Fed meeting. That's how you wanted things to go. Yeah, I'm pretty bullish. I mean, can't really say it any other way. So it's what you want to see. It's what you kind of been waiting to see. So big fan. If you have any questions, I'll try to answer them real quick. I don't see any questions. But yeah, I don't think there's any question. My Q's lives. Nice. SPY will tank when they bring out the numbers. He kept saying, and this is just a story right now. Again, yeah, people that are bears, again, like you can't say anything. Like if you're just completely biased and you're leaning towards one side of the trade, I mean, I could tell you that there's, Donald Trump's going to turn a money printer on and hand out free dollar bills to everybody, and you would still be bearish. So, when you're closed-minded and all you're looking at is whatever you think the market's going to do, again, you're probably just going to lose a bunch of money. It's like I say in all my videos, guys, stop trying to predict what's going to happen, just react to what is happening. And as of right now, from the Fed meeting, looks very strong. Above 25.87, you're gonna see some pretty good movement. So again, see you guys in the next video around 6, 7 o'clock. Have a good one, guys.